Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. At least I was last time I checked. Today is Monday. It's November 7th. The first week of November's over. We've got the time change to deal with. I woke up this morning with a nasty hangover. This time change is for the birds, really. I don't know what we need it for. Anyway, it's about 7:55. I hope everyone had a wonderful, wonderful weekend. Please, please, please like this channel, subscribe to these videos, and comment below these videos in the YouTube channel, and I will respond back. The market's going to open up in about, let's see here, an hour and 35 minutes to be specific with you. And we've got a very, 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 very busy week. Let me give you some idea of what's on the table this week. First of all, we've got the CPI. This is a big, big report, and this is a major report that the Fed is looking at, and I'll get into the details of it as the week continues. Again, their biggest factor, what they're looking at is not the headline number. What they're looking at is the core CPI, and the core CPI, which is going to be released in 4 days, it's right here. They're only looking at annual year over year, and they're looking at 6.6%. So that's going to be the target number, and 8%, which is the headline number. But I'm hoping that this number is finally lower, but I'm not sure if it will. Last few times it hasn't been. Also, we've got the midterm elections. Now, remember something, and I don't like to get too political. It looks, as of right now, it looks like the Republicans are having a lead. But remember something, it's probably going to be a pretty messy election, and they're probably going to have recounts and all of this stuff. So we may not have a final answer well into end of next week, maybe even the week after. So brace yourself. We're going to have a lot of volatility and a lot of unforeseeability as a result. But I want you to know that typically these type of events don't have as big of an impact on the market as, say, the CPI or Fed, especially in the current environment we're in right now. Because even if there is a change, it's not going to make a difference tomorrow. It'll make an impact, over the next several months. But it's not something that's going to give us an immediate fix, and it's not going to fix this economy. It may be a good start, but anyhow. So we do have that right now. From where I'm sitting, it looks like Republicans are in fact leading. We'll see how it goes. We'll have more briefings as that continues. Let me talk a little bit about the broad market, and then we'll get into the nitty gritty. So 3 benchmarks all rebounded on Friday, but the week still ended up being lower, and I'll explain to you what my major fear is right now. The Dow Jones. I want to kind of go through this with you, go back and forth. What I'm concerned with about is the fact that the Dow Jones is going to have a really difficult time breaking through the 200-day moving average, and my indicator, the RSI, is doing exactly what it did right here, very similar to what it did right here too. So to me, it looks like we're going to huff and puff and look like we're going to break out, and then we're going to come right back down. The bond market is kind of doing that. So I'm very skeptical that this is going to be the bull market rally, because if the stock market breaks out above the 200-day moving average on the Dow, that's a very, very powerful rally, and I don't think the market's anywhere near there right now. The big gains are coming from basic materials, financials, and industrial sector. And when you're looking at the industrial sector, make sure you look at the industrial sector as a defensive sector, because you have all the war defense stuff, and then you have the regular traditional industrial stocks. We had non-farm payroll on Friday, which was a really bad number. It was raised up to 261,000 from 200,000. I think one of the reasons why the market rallied is because the market is thinking if the number is getting really bad, the Fed may stop doing what they're doing. Don't think that's going to happen. I don't think that's in the card. I think they're on a mission. Again, ahead this week, as I mentioned, we're going to be watching the CPI. That's coming out on Thursday. They're looking at 0.6% month over month, 8% year over year, compared to 8.2% year over year. And again, as I mentioned earlier, they're going to be looking at the headline annual number year over year. And I'll go through that right now. 6.6. This is the number they're going to be looking at. 6.6 and 8%. Those two numbers will give us everything we need to know. If the number's below that, that's a very positive sign. If the number's above that, very, very negative sign. Now, let's continue this. So that's what they're looking at. Meanwhile, and this is subject to debate because I think the Fed left the door open last time by saying we have to take into account the lag. I think that's the first time they've said that. That basically means we may have to kind of wait and see what happens based on the last 3 rate hikes. That's how I'm reading what they said last week. So now, if you look at the bond market, there's a 56% chance that we're going to have a half a handle rate hike and a 43% chance of a 75% rate hike. Now, what will be very, very interesting to see is throughout the next couple of weeks how these two numbers fluctuate and whether this number increases, and if it does, then this number will decrease, or if this number increases, which will cause this number to decrease. It'll be very, very interesting. Also, investors are now pricing in a peak of about 5.1 for the Fed fund rate compared to just under 5% in November meeting. So again, the number's not going lower, it's going higher. In addition, investors are likely to focus in on what the Fed is saying in terms of what they're actually talking about. Again, we got congressional midterm elections. That'll be the spotlight. Analysts say surprise win by Democrats could increase volatility amid concerns about more fiscal spending and inflation, and I agree, but I don't think right now it looks like Democrats are leading. It looks like Republicans are leading, and if that's the case, that may cause a few sectors to strengthen a little bit. But remember, midterm elections don't change the market cycle from a bull to a bear or a bear to a bull. There's got to be a lot more to happen than that, like actual economic activity. European stocks were steady after Chinese exports and imports contracted in October. Chinese government reiterated its commitment to maintaining a strict, I think, zero COVID-19 strategy, which is crazy. German industrial production came in slightly stronger. Chinese indexes rallied last week on growing speculation that they're going to scale back their COVID policy. However, officials from the Health Commission said over the weekend that the country plans to maintain strict COVID-related curbs. They're like a wet blanket. The Nikkei closed down a little bit over 1% and hit a 1-month low. Not really great for U.S. stocks. And we are still having earnings season. Now, volatility looks like it's starting to come up a little bit. One of the reasons why I got rid of the short, I had a short in VIX. We got rid of that short because I anticipated volatility to pick up we got CPI, we got the midterms. It's very hard to believe that volatility is going to go down this week. Also, the bond market is starting to cool off. And if you look at the sectors that have been taking us down, they are in fact making new lows or at new lows as we speak right now, or very, very close to new lows right there. So I'm anticipating these sectors to hold on, but sectors like the energy sector, for example, could see a little downside. Utilities could see a little downside because remember, these reports impact the entire economy. Financials could see a little downside. I'm actually short financials right now, and notice it's below the 200-day moving average. So my theory is that stocks are going to cool off because we are still below the 200-day moving average. And quite honestly, till the economy straightens out, we should be below the 200-day moving average. If you look at the put-to-call ratio, we're kind of on the neutral zone between bulls and bears, so it can go either way. If you do look at the sectors, notice we're getting a lot of green here, but a lot of red here. This is not increasing. And the last time we saw a major rally where we saw the stocks in the 50-day line go up, and the stocks in the 200-day did not, we ended up reverting back down. And I'm fearful that that's going to happen right now, especially with only 54% of stocks in the Russell above the 50-day moving average, 57% in the S&P. This is a lot of vulnerability, 58%. But if you look at the 200-day, only 28% of stocks in the Dow Jones are trading above the 200-day moving average, 37% in the Russell 2000, 35% in the S&P 500. So that's a lot of vulnerability towards the direction of the bear. NASDAQ 100, 25%. Only 45% are trading above the 50-day line. My point is, when you see these sectors heat up, get into the green, but this is red, that's a lot of vulnerability. A lot of vulnerability. Now, if you look at the number of stocks making 20-day highs, which is something we look at a lot, the number is heating up. It's not too high. It's only about 273, so there's more upside to go. But I think this week is going to be rather choppy, and I think we're going to see a lot of surprises. We still have earnings. We've got midterms. We've got the Dow literally bumping against the 200-day moving average. The bond market is taking us down. Volatility looks like it's starting to, let me just kind of show you on a different chart. Volatility looks like it's bottoming out right here, which means it can start coming back up. This is a very, very dangerous time, so you want to stay defensive. Now, speaking of defensive, if you look at the 11 sectors, the major sectors, you're not going to see any surprises. Energy, industrial, healthcare, financial, consumer staples. Not sure if financial belongs up here right now because of interest rates. That can go either way. Basic materials should be closer to industrial. What's bringing industrial higher than normal is the defense companies, the Lockheed Martins, the Ryans, the big defense companies. Utilities is finally up here. It should start coming up. The way it should look theoretically is technology, consumer discretionary, communication services, and up here you should see energy, healthcare, consumer staples, basic materials, and utilities. So the sectors are really, really out of whack. They're fragmented, and it usually takes a little bit of time and a market to cool off for them to come up. I'm not discouraged as much as I was about the market, but I think investors need to be patient right now, because the markets are setting up for more craziness. But when I'm seeing the 50-day line getting a little overbought and the 200-day still kind of on the chopping block, I get very, very, very nervous. It's going to be a very big week. I'm going to try to increase our long exposure, so we have right now more shorts than longs. We have Marriott short, Six Flags Magic Mountain short, Norwegian Airlines short, XLF short. What else we got short? A bunch of stocks. We're short a lot of consumer stocks right now. Budweiser, we're short. But I want to show you why. I want to explain to you why. See, if you look at these stocks, you'll see that they're humming right at the 200-day moving average. See that? They're still in a downtrend. Let me look at Marriott. They're still in a downtrend. Most of these stocks, see that? They're still in a downtrend. Norwegian, what is Norwegian? They're not ready to rally yet. So again, I think we're going to see a lot of QDEL, another one. I think we're going to see some more downside, and I think we're going to see some corrective action taking the markets back down to the base. But we may see some upside as well in certain sectors. If you're going to go long, stick with energy, defensive. And if you're going to short, consumer stocks are probably the best thing to do. Now, just a heads up, folks, that we see an uptick in volatility over the next week or so due to midterm elections. In fact, Lance and Polito's are already starting to see higher volume paired with bigger stock moves. If you want to see for yourself, a live trading session today at 1 p.m. Eastern Time to review some unusual activity that he's spotting in a few specific stocks. Now, Lance is very good about this. His goal is to find a handful of tradable opportunities Monday afternoon going into Tuesday morning. So, if you'd like to look over his shoulder as he's hunting some of his high volume plays using the master indicator, click the link below and RSVP. He has some pretty high hopes for Monday afternoon. You definitely want to check it out. So, if you're not too busy, and I know you're not for Lance, check it out. It's happening at 1 p.m. Eastern Time today. 1 p.m. Eastern Time today, Monday, master indicator, Lance. What else do I need to say? We'll roll our VIP room into that at 1 p.m. Do not miss out. It's going to be very, very cool. 1 p.m. Eastern Time, Lance, Monday before the midterm elections, earnings, all the stuff that's going on with the Fed. Let Lance clue you in on what's hot. And I'll talk to you guys later. Remember, if you're liking this video, subscribe to this channel, like us, and comment below this video. Bye, guys. Talk to you soon. Have a great, great day and the rest of the week. It's going to be a crazy one.